Hello everyone, thanks for checking out my video. It was a brutal week for the stock market. Both S&P 500 and Nasdaq have entered the correction territory as they fell more than 10% from its July high. The S&P 500 has lost over $4 trillion in value since July, and the Magnificent 7 tech stocks have lost more than $1.2 trillion in the market cap. Specifically for Google, it recorded its worst single-day sell-off in more than 3 years, by falling 9.5% one day after it reported its earnings, wiping out $166 billion in market value. For context, that's more than the entire market cap of Disney or Nike. So as we enter November, will the doom and gloom market continue, or can we expect some form of rally into the year end? And oh, I have lots of things to unpack for my options trades, therefore please stay throughout the video to find out more. Last week, the sell-off in the stock market intensified as the major indexes all fell to multi-month lows amid mixed companies' earnings. On Wednesday, Nasdaq recorded its worst trading day since February this year as mega-cap stocks slumped across the board, with the earnings season for major tech giants went into high gear. Despite better than expected results from Alphabet and Meta, investors dumped the stocks and the rest of the tech sector last week. Alphabet shares dropped about 9.5% one day after it reported its earnings, clocking its worst performing day since March 2020, where the COVID-19 pandemic hit the world. It was also its worst weekly performance since that period. For your information, Meta, Google, and Tesla have lost over $200 billion in just 1 week. And then on Friday, the S&P 500 officially joined the Nasdaq in the correction territory, which is defined as a decline of more than 10% from its recent high. Not just that, S&P 500 has dropped to a new 5-month low. On the very same day, Friday, the Federal Reserve's preferred inflation matrix, aka the PCE index, was released. On a headline basis, which includes all categories, PCE rose 3.4% over last year. As for the core PCE, which excludes the volatile food and energy categories, showed prices rose 3.7% from the prior year. Both are in line with expectations. Although the annual price increases continued to cool, the prices over the prior month jumped by the most since May. My take is that the core PCE figure is showing that the inflation is still a little sticky, which sharpens the prospects for the Fed to keep interest rates higher for longer. The Federal Reserve will be meeting this week on 31st October and 1st November. They are widely expected to keep the interest rate unchanged at the conclusion of its policy meeting. A few of the Fed officials, including Powell himself, have previously signaled that the surging bond yields could help the Fed in slowing the economy, further cooling inflation. Therefore, there is almost little need for the Fed to take further action or raise interest rate. The announcement will come on the second day of the meeting, 1st November, and I believe Powell will likely reinforce this message together with his higher for longer slogan. On the earnings front, there is a lineup of high-profile earnings reports this week, with the biggest US company, Apple, being the main one to watch. Just to add on, Apple will hold an unexpected product launch event titled Scary Fast on 30th October. Rumors about the event have been mixed, but the market is widely expecting the event to be focused on Mac. Basically, new Mac laptops are expected as well as a faster M3 chip. Anyway, other notable names that are reporting earnings this week are tech giants such as AMD and PayPal. Then you have Starbucks and McDonald's in the consumer discretionary sector, speculative stock Palantir, and the so-called pandemic or Katie Wood stocks such as Zoom, SoFi, Roku, and Shopify. All I can say is that it's going to be a very busy week, and this week could set the tone and trend for November. Talking about market trend, it brings me to the next segment, which is the technical analysis. Let's first take a look at SPY. Do pay attention to this because it represents the overall market and does give you an indication of where the market is headed. Anyway, the key levels for SPY have been broken. In my last video, I shared that I was expecting SPY to test the recent low of 420.18 and may even break below it to create a new recent low. And there you go, SPY has fallen to a new 5-month low. In addition, I also mentioned that if 200 moving average gets breached, we are looking at below 415. And there you have it. I hope that warrants a like button from you. Okay, right now the broader market is quite oversold as shown on the RSI indicator. But can it go lower? Of course it can. Let's say the weakness continues this week, the next level to watch is actually the psychological level of 400. And mind you, for SPY to drop 10 points from the current 410 to 400 is quite massive. Just like last week where it fell from around 420 to 410, and we all saw how red the market was. One thing to watch this week is the last Friday's low. If early in the week we broke last Friday's low, which is around 409, then I wouldn't go long yet. Because when that happens, I think the gap between 404 to 405 could act as a magnet to pull SPY towards it. This gap could act as a support, followed by the 400 level that I have mentioned. But given that the market is so oversold right now, I think, just a sensing okay, it is quite unlikely for SPY to break below 400 this week. But if I am wrong and if it does break below 400, then watch for the last line of defense at 397. If this breaks, 380's range could come into picture. For bulls out there who are waiting for an oversold bounce, you would want SPY to reclaim two key levels. One is the 420 level that I have been talking about for months, and the second one is the 200 moving average, which coincidentally is sitting at 420 as well. By closing above 420 for about 2 days or so, then we can say SPY has temporarily broken the near-term bearish trend. Also, by doing so, it does open a possible path towards 428 to 430 area, which is roughly the top end of this downtrend channel marked by the purple lines. Alright, here's something to note. If we have a bounce this week, don't be too excited yet. Because the last two times we have a RSI oversold bounce, SPY fell back down again. So basically, to summarize, SPY has to break out of the purple downtrend channel before we can call for a year-end center rally. Let's move on to Apple. Apple is looking very similar to SPY. That's why people say Apple is a market moving stock, because of its weightage in the S&P 500 and Nasdaq index. So just like SPY, it broken its recent low and went below the 200 moving average. That's bearish, which I think you can tell as well. What we are all interested right now is where is Apple headed next. Yes, we all know this week's earnings is key and the product launch could also affect the stock movement, but how do we get indication of the next direction? Will it do an Amazon and Microsoft, or will it do a Google and Meta? The first level to watch is 164. I repeat, 164. This is the first Fibonacci level below the 100% retracement level. Not only that, this level also coincides with the long-term downtrend red line. If this gets breached, there is a decent chance we head towards sub-160s. Interestingly, there is a tiny gap between 158 to 159, which you may not be able to see on your screen. This gap was created in March this year, a good 7 months ago. So if 164 breaks, this could be bear's target, with the last line of defense at 155. But just like SPY, Apple is oversold on the RSI. We could have a technical rebound. If it comes, don't get too excited yet, because it could be a dead cat bounce, which means a bounce up and then drop further down. So for Apple to regain a bit of bullish momentum, it has to reclaim its 200 moving average decisively and stays above it for at least a few days. To really reverse the near-term bearish trend, Apple needs to go above 173. In short, below 173 and below the 200 moving average, which sits at 170, Apple is bearish. In my view, it doesn't matter if it is going sideways at current level, because that's like standing at the edge of a cliff. Any small push could send Apple falling down. Moving over to Tesla, it's quite straightforward this week to me. Somehow, Tesla looks a little similar to Apple and SPY because it also broke below the 200 moving average as well as its recent low. Okay, for Tesla, it is sitting at a dangerous spot right now. Reason being, it has been flirting with this 200 moving average 5 times out of the last 6 trading days, but bulls are lacking power to push above it. On the other hand, bears seem to push it below 200. Therefore, it has been trading in this very tight range of low 200 to 220. But I believe at the end of the day, someone or something has to give, and the pivot point would be this 200 moving average. If bulls can put a few candles above it, that's slightly bullish. For resumption of bullish momentum, Tesla has to go back above the green uptrend line. By doing so, it will also bring Tesla above the 38.2 Fibonacci level at 228 and could potentially send it further up into the gap area, which ranges from 230 to 242. On the other hand, if Tesla's retest of the green uptrend line or even the 200 moving average fail, then bears could finally bring it below 200. Below 200, I think bulls would want to look away. It could potentially flush towards 180s or 170s range as it enters this area of consolidation. Let's now move over to Google. Google is wow, just wow. As shared earlier, the amount of market value that got wiped out in that 1 or 2 days is simply crazy. If you recall, in my last video I shared that 134 was a triple support level and bulls have to hold that line. If it gets broken, it would be very bearish and we will go below 130. And Google did exactly that. It was floating above 134 early last week, but when that broke, it basically plunged. And oh, please give me a like if that has benefited you. Just to highlight, Google has finally broke out of this 127 to 139 consolidation zone that I have covered for months. From this point, it's quite straightforward. As long as Google is trading below 127, it is bearish. The current immediate support level is 120. 120 in my opinion is a strong support, which bulls had defended well last Thursday and Friday, but it was just 2 days, so we have to watch if it holds this week. If 120 breaks, the last line of defense is the 200 moving average at around 116. If both levels get taken out, I think there is a high chance that the gap between 112 to 114 will be filled. Okay, here's the saving grace for the bulls. So far for the last 1 year, whenever Google's RSI hit the current level, it has been followed by a bounce. The stock could consolidate a little bit, but always ended up bouncing. But before bulls get too excited, you will have to see if the bounce is sustainable. I mean, it could bounce and then fall back down, right? Then what's the point? But if you are an option trader, then yes, sideways movement or small bounce could allow time decay to work in your favor. More on that later as I open a trade because of this. Anyway, on the upside, the first target for bulls is to fill the small gap between 124 to 125. Then Google needs to go above 127 before we can say that Google has slightly reversed the bearish trend. For full reversal, it's simple. Fill that big gap between 128 to 137. Okay, I know it may sound a bit unrealistic to fill it entirely, but Google should at least close above 130, then we can say bulls are gaining back control. Alright, moving over to the options trading segment, I have a number of things to cover this week. First of all, I have 2 sell put contracts that expired worthless last Friday 27 October, one on Google and one on Microsoft, and in total they both gave me about $400 profit. Next, I have this sell put contract on Bank of America that expired in the money last Friday. My strike price was $26 and the closing price was about 25.1. I could have wrote the option to a further expiration date to let the stock recover, but I decided to take the assignment. So what's gonna happen next Monday is that I will see 100 shares of Bank of America in my account. The cost price would be my strike price, which is $26 per share, less the premium that I receive. And what I am gonna do next is to sell a covered call on this 100 shares to earn more premium. This is called the whale strategy. And the reasons why I didn't mind getting the assignment are because my personal view is that $26 is a decent price for the stock given its recent strong earnings report. But of course, Bank of America has its own red flags, which I'm not gonna do the fundamental analysis here. Anyway, I am also of the view that the market has overreacted on the uncertainty of the economy as the whole financial sector had a sell-off last Friday. JP Morgan sank 3.5%, the biggest one-day drop since it fell 3.8% in March. Citigroup, Wells Fargo, and Morgan Stanley all fell between 2% to 2.5%. Bank of America went down the most and dropped below the low of the banking crisis that happened in March this year. In fact, it has hit a 3-year low. All being said, can the weakness and overreaction continue? Of course it can. It can fall further to $22, $20, or even below that in the short term. But I have done my research and I am really okay to hold the shares for the long run. Moving on, the next trade to share is this Google covered call. Not gonna hide anything, if you have been following me, you would know that I have been stuck in this covered call for the longest time, rolling and rolling. The last time round when I wrote this contract, I wrote it till 15 December, so that I didn't need to look at it for a while. But guess what? Google plummeted and it caught my attention, and I did something very unconventional. I basically wrote or brought forward the expiration date. You know, usually option traders roll their trades out to a further expiration date, but I did the opposite by rolling it backwards. And I even did a Google search, googling for my Google trade. How nice. Anyway, the interesting thing is that I didn't manage to find many articles or materials on rolling an option backwards. I have only managed to find one article by Investopedia, so if you know more about this type of rolling option method, please comment down below. As you know, I am still a beginner, so I am definitely willing to learn more. I mean, we are always learning something new from the stock market, isn't it? Anyway, the reason why I brought forward the expiration date is because I wanted to lock in the profit first, and also make the days to expiration shorter. Reason being, the time decay set in faster as we go closer to the expiration date. Not just that, short-term wise, Google is looking bearish and we never know if this bearish trend will last all the way till 15 December, which was my original expiration date. My take is, the longer we drag on, the higher chance for Google to go up after the dust has settled. Therefore, I decided to bring forward the date and see if the bearish trend can continue at least till early December. But the market doesn't care about my view, and Google could just fly to 130 by end of November, and that may make my trade irrelevant. We shall see. Okay, next, still on Google, I opened a new cash secured put on Google last week. No live recording this time as I try not to let viewers follow my trades blindly, because that can be quite dangerous, especially in the current volatile market. So anyway, I sold this put contract on 26 October Thursday with a strike price of 115 expiring 1st December. A summarized version of my thought process is that Google has clocked one of its biggest single day loss just a day earlier before my trade. And on the day when I made that trade, it was also showing weakness. If it's so bearish, why did I still sell this put option, which is a slightly bullish move? Well, the 2 straight days of huge decline has brought Google's RSI to a very oversold level, so we could have a chance of a small bounce or sideways movement. To manage my race, I have 2 important levels to help me out, and they are 120 and the 200 moving average at 116. My strike price is below both of these strong support levels. But the caveat here is, strong support levels don't mean they can't be broken. Look at Apple, look at Tesla. If Google flushes down and take out these 2 levels, so be it, I may just take the assignment. But why would I want to do that? Well, don't forget, as shared earlier, I have a covered call of 120 strike price. If that covered call gets exercised and my 100 Google shares get caught away, it will mean that I am selling away my 100 Google shares at $120 and then buy them back at a cheaper price of $115. Isn't that nice? Alright, last week the indexes tried to bounce early in the week but fell sharply once again, breaking key support levels in the process. To add on, a few mega cap companies reported decent earnings, yet they were rewarded with a big sell-off. So it's quite obvious that the bears are in control of the market right now. With the ongoing Israel-Hamas conflict, elevated treasury yields and high interest rate environment, fear is building up in the market. I mean, as you can see from the fear and greed index, we have been floating around this extreme fear and fear areas for the last 1 month. In addition, VIX, which is the most well-known measure of the level of fear or stress in the stock market, popped recently. It has spiked to a 6-month high recently. So, viewers out there, are you feeling jittery and nervy? If the answer is yes, great, because it's this kind of period where more and more people are getting fearful of the stock market that I picked up some discounted shares of fundamentally good companies. If you have been following my videos, you would have known that I have done this on a few occasions over the last 1 year plus. Just to share, I have done a video at the start of last year on the stocks to consider in 2022. So if you have picked up some of these shares back in 2022's bear market, your portfolio should be up decently despite the recent sell-off. I have linked the video at the top. And here's a quick look at the 5 stocks that I have mentioned. Year to date, Apple is up 34%, Microsoft and Google gained 37%, Meta jumped 137%, Nvidia popped 182%. I have also done a separate video on Tesla. Again, the link is at the top. And year to date, Tesla jumped 91% despite the recent drop by more than 10%. But please note that these are not financial advice or stocks recommendations, okay? Alright, so why am I telling you all this? Well, the message that I want to bring across is when the market is shouting doom and gloom, maybe it's time for you to sit down and filter out some of the good companies that are selling at a discounted price. Yes, I know it may seem scary to pick up shares during fearful period like now. But hey, Tesla was at low 100, likewise for Meta. But look at where they are right now. Managing emotions is actually one of the toughest things to do in the stock market for both long-term investors and short-term traders. So this is the time to put your emotions to test. With all being said, don't be in a hurry to get back in or go all into the stock market right now. Do your homework, and as much as I don't want to be a broken recorder, I am gonna repeat the same thing, and that is to dip your toes in bit by bit, pick up shares in tranches. As we approach the end of the year, if the market goes down, you will still have cash to pick up more shares. But if the market goes up, you already have some money in the market to ride the upside. Okay, overall sentiment wise, given how bearish the market is right now and that the elevated level of VIX is showing extreme fear in the market, a reversal could be coming. Technical wise, I am also of the view that we are due for a bounce due to the oversold condition. It's kinda imminent. But of course, I could be wrong. That is also why it's important to know the key levels for S&P 500 and watch them carefully. So let's say if we have a bounce, whether is it going to be a dead cat bounce, oversold bounce, relief rally, or whatever you wish to call it, it remains to be seen. Alright, that's all for this video. Please help me grow my channel by liking and subscribing. Thank you.